People, listen to me. If you are retired, or if you are waking up every single morning counting down the days until you can finally say goodbye to the 9 to 5, you need to stop what you are doing and pay attention right now. Because the financial landscape under your feet just shifted in a massive way, and if you are sleeping on this, you are leaving your money on the table for the government to take. I am talking about the One Big Beautiful Bill Act. You've seen it in the news, you've heard the politicians talking about it, but nobody is telling you what it actually means for your wallet, your retirement accounts, and your peace of mind. I know what you are feeling right now. You are feeling afraid. You look at inflation, you look at the rising cost of healthcare, you look at your hard-earned nest egg, and you wonder, am I going to run out of money? Is a single tax change going to wipe out my security? The greatest fear in retirement is the fear of the unknown, the fear of a tax bill you didn't see coming that forces you to change your lifestyle or downsize your dreams. But fear only happens when you don't have information. Today, we are turning that fear into power. I am going to break down exactly what this law does, who it helps, who it hurts, and the exact steps you need to take to protect yourself. Let's start with the big question everyone is asking: is the government finally giving retirees a break, or is this just another trap? The answer is both, depending entirely on whether or not you know how to play the game. The single biggest change in this entire law that you need to know about is the brand new Senior Bonus Deduction. Listen to me closely. If you are age 65 or older by the end of the tax year, the government is handing you an extra $6,000 tax deduction. If you are a married couple and both of you are 65 or older, that is a massive $12,000 extra deduction. And this is not instead of your regular standard deduction. No, this is on top of it. This is a bonus. It hurt retirees who chose to stay in their family homes. This new law finally raised that cap significantly, up to $40,400 starting now. That sounds amazing, right? But listen to me, it is heavily restricted. If your modified adjusted gross income is over $500,000, you don't get it. And remember, you only get this if you itemize your deductions. For the vast majority of retirees, taking the newly juiced standard deduction with that $6,000 senior bonus is still going to give you a bigger write-off than itemizing with the new SALT rules. Do the math before you assume this helps you. And what about healthcare? Your health is your wealth in retirement. If you don't have your health, you have nothing, and if you don't have the money to pay for your healthcare, your retirement security evaporates. The House version of this bill tried to allow people on Medicare Part A to continue contributing to a health savings account, an HSA. Retirees everywhere were cheering for this because an HSA is the ultimate tax-sheltered vehicle. But when the final bill was signed into law, that provision was cut. It did not make the final text. So hear me clearly, once you sign up for Medicare, you still cannot contribute to an HSA. They updated the rules around the Affordable Care Act premium tax credits. If you are using the healthcare exchange to bridge the gap until Medicare, your premium caps and subsidy eligibility have been restructured. This means you can manage your retirement income to keep your healthcare premiums incredibly low, making early retirement far less dangerous than it used to be. Look at the big picture here. This law is an absolute wake-up call. It proves that the rules of money are never permanent. The government can change the goalposts whenever they want, and if you are operating on old information, you are the one who suffers. So what is your actionable takeaway today? What do you need to do right now to ensure your retirement stays secure under this new law? Step 1. Sit down with your tax professional or your financial advisor before December 31st. Do not wait until April when you are filing your taxes. By then, it is too late to change what happened. You need a multi-year income plan. You need to look at your expected income for this year and see exactly where you land relative to that $75,000 or $150,000 phase-out for the new senior deduction. If you are just a few $1,000s over the line, look for ways to lower your adjusted gross income. Can you contribute more to a traditional retirement account if you are still working part-time? Can you utilize a QCD for your charitable giving instead of taking a taxable withdrawal? Small shifts can save you thousands of dollars in lost deductions. Step 2. Evaluate your Roth conversion strategy. Because these tax brackets are locked in and permanent, you know exactly what the tax rates are today. Map out a plan to systematically convert small portions of your traditional IRA into a Roth IRA over the next few years. Fill up your current tax bracket right up to the edge, but be absolutely certain you do not cross the line that triggers higher Medicare premiums or phases out your new senior bonuses. It is a delicate balancing act, but when you get it right, you create an income stream that the government can never touch again, no matter what crazy bills they pass in the future. Step 3. If you are planning to buy a vehicle in retirement, take a look at the new deduction for car loan interest that this bill brought back. For the first time in decades, you can deduct up to $10,000 a year in interest on a loan for a brand new, American-made vehicle. If you have the cash to buy a car outright but you can earn a higher interest rate on your savings than the loan costs you, and you can deduct the loan interest, it might actually make financial sense to finance that vehicle. But remember, the vehicle must be assembled in the United States, and you have to list the VIN on your tax return. Your retirement security is not defined by what Congress does. It is defined by how you respond to what Congress does. The one big beautiful bill can be an incredible blessing to your retirement portfolio, or it can be a missed opportunity that costs you thousands. The choice is entirely up to you. Get informed, take control of your income strategy, and protect your hard-earned money. Because nobody cares about your money more than you do. Stay safe, stay smart, and stay secure.